Welcome to the Startup Operator Podcast. I'm Roshan Karyappa. My guest today is Andrew Stotz, who is an investor and entrepreneur. Andrew runs the popular podcast My Worst Investment Ever, where he interviews people about, that's right, their worst investment and what they learned from it. I was on the podcast some time back, and I thought it would be cool for Andrew to pick on some of his favorite mistakes that people have mentioned in over 350 interviews that he's done. Now, these mistakes range from founding a startup to investing in a house or a car. For the purpose of this podcast, I asked him to restrict himself to founders and startups, and that's what we spoke about. So he went over things like failing to do research, not managing risk effectively, being driven by emotions instead of being data driven, misplaced trust, not monitoring your investments, and so on. This is a great refresher for people about running a business. I hope you like it. Hey, Andrew, welcome to the Startup Operator Podcast.
Great to be here and be here with your audience. I'm excited to share, what I've learned.
Yeah, thank you so much for being here, Andrew. And for everyone listening, Andrew and I recorded a podcast some time back, maybe a couple of weeks ago. Andrew runs a podcast called My Worst Investment Ever, which is a super interesting podcast. I really encourage you all to check it out. And, as failure is the flavor of that podcast series, we thought we could use some of those learnings as well. So I have Andrew here to present the 6 most common mistakes that startups make. So, Andrew, over to you.
Let's go, Roshan. So first thing is, I just want to say to everybody out there, if you're a startup operator or you're thinking about a startup, I have proof that you're crazy. And my proof is this. We know that only maybe 5% of startups really make it to the big time and do really well. In fact, you could probably say maybe only 1% really make it to the huge big time, right? But when you talk to a startup operator, what you find is that every one of them thinks that they're going to be one of the 5%. And it is that madness that tells us that, in fact, the startup operator is somewhat crazy, but yet we need that craziness to drive the world. So I have a lot of respect. And in my case, I've done 4 startups in my life. The first one I sold, and then the second one I basically still have. It's now a 25-year-old company. I have another one that crashed and burned. That was a tech startup that crashed and burned and lost me a lot of money, which was very painful. And then I had my other business, which I run now, Stotz Investment Research, which is in fact a successful startup. So now I've interviewed 350 people at My Worst Investment Ever. And I thought the best way to do this is just to go straight into what I have found are the most common mistakes. What do you think, Roshan?
Fantastic, Andrew. I think this could be very insightful for all of our audience who's listening.
So I'm an analyst, and that means that I analyze the things that I get. So I went through all of my episodes and I tried to classify them into the most common. And I'm going to identify 6 common mistakes. And the first one is, and this is the most common, is failed to do their own research. It's shocking how many people devote their money, time, and energy to ideas and investments that they do not really know anything about. Now, remember, when I'm talking about these worst investments and these common mistakes, I'm talking about them generally. But I'm going to have a surprise at the end of this for your listeners that will be some added little bonus that I've never before revealed. So the first one is failed to do their own research. Have you ever seen that, Roshan?
That's an interesting one, right? Because oftentimes, startup folks tend to be indignant about convention, right? They tend to look at things the way they are and say, why is it like this, right? Why not this or why not that? And I really feel, people should put in the work to understand the context and understand why things are the way they are before they break it,
Yep.
So yeah, I definitely relate to what you're saying.
And the thing is that all of my 350 episodes, not all of them, of course, are startups. In fact, my first pass, I'd say it's about 50 of them that are startups. But so I'm just talking about generally. So let's go to the next one. Number 2, fail to properly assess and manage risk. And, I think of assess as before you make the investment, and I think of manage as after you've made the investment. How are you handling that risk? But it's been amazing to see so many people that just have no clue. It's like they're walking around with rattlesnakes all around them, and they don't even know what a rattlesnake is. It's like a baby walking around a bunch of rattlesnakes in the desert. They just fail to properly assess and manage risk.
Yeah, this is what we spoke about, I think, on my podcast, right? Understanding risk and probability, right?
Yep.
I think, founders tend to be problem solvers, and you give them a problem, they get really excited about it, and they go about trying to solve that problem, right? But analyzing the market, analyzing the business, having a good handle on the data, and your probability of success in that particular domain is super important, right?
Mm-hmm. Yep. Totally. And that's why, I actually do, because I do a lot of case competitions in startups, I've gotten together 29 questions that a startup must be able to answer in order to, get funding. And in fact, I've changed the name of that. I do it as a free webinar called You're Funded or You're Funked. I won't use the bad word there, but you're funded or you're screwed, basically. And the point is that part of what matters when it comes to funding is seeing what level of experience people have in dealing with those particular risks. So that's why investors like to invest in people who have failed.
Yeah. Yeah.
Okay. Number 3, driven by emotion or flawed thinking. These are what we would call behavioral biases, thinking biases, but it's a very, very common thing that people get sucked in. In fact, just this morning, a friend of mine called me. He's 70 years old. He's living off his retirement. It's not a large amount of money. So he's just living, a basic life. And he talked to me about his investments in cryptocurrencies. And fear of missing out has gotten him sucked in. Mm-hmm. And who knows where this could end. But it could end very, very ugly. But the power of emotions to follow into an investment is extremely strong. Also, what I've seen is many people, their thinking and their analysis of situations break down, particularly for startups when they get that entrepreneurial seizure. They're so excited, it just can't go wrong. So really that emotion and thinking is critical.
Yeah. This episode is brought to you by Mulya. You want to move fast? Sure. But without breaking things? Now that's a hard ask. The thing is, once you have some base of users and customers, you just cannot afford to risk quality. So how do the likes of Cred, Swiggy and Curefit, some of India's fastest growing startups, ship at lightning pace and delight their users and customers? Simple, they're working with Mulya as a strategic quality partner. Mulya is India's most talented and passionate community of testers. They've helped prevent thousands of bugs and regression issues. So as a CTO or a product owner, if you want to reduce tech debt, especially while you scale, do check out Mulya.com. I've interviewed Mulya's founder and CEO Pradeep on the podcast earlier, and we spoke about how startups can improve quality while scaling and things to that effect. You should definitely check it out. I'll link to it in the description below. Now back to your regular programming. They're caught up by the excitement of solving that idea, and then it sort of feeds into their ego as well, right? So it really helps to abstract yourself away from that and see things as they are. So I completely agree. A lot of the founders or operators, especially in hypergrowth startups, tend to be upwards, downwards, sideways on most days. Right. And really keeping a check on your emotions and doing things in an objective fashion, well, as best as possible, is something that could be really, really beneficial.
So your listeners, Roshan, probably are thinking, oh, man, you're just talking about losing. I want to hear about how to win. Okay. Well, I want to tell a little story. And that is one of my businesses is a coffee business. We've been in operation for 25 years. We're a B2B coffee roaster. We've got about 100 employees. And we were thinking about expanding to Vietnam. And basically my business partner and I we're equal shareholders in the company. And we decided that he would look into it and pull together the bull story, like why we should do this. And he spent a few months. And then one night he presented the whole case of what the potential upside of this. And he made a point of not speaking at all about any downside risk. He only talked about the upside. Now, why is that? Because we agreed that that's all that meeting would be about. We went through the projections, we went through everything. And at the end of the meeting, we both said, well, that was great. Let's go have our dinner. And then we went to eat and talk some more. And then we decided that the following week, we had already previously decided, would be when we discuss the risks. So my advice in order to overcome the issue of fail to do your research and fail to properly assess risk is to separate the work that you do on risk and return. And it allows you to think differently about the risk. Instead of me challenging everything that he was saying, let him go. But it also meant that when we decided just to talk about the risks, he was much more able to go through it. So that's a big piece of advice of how to offset the first two. And I wanted to give a piece of advice about the third one, which is driven by emotion or flawed thinking. And what I say is find, explore, and list opposing views and discuss them with a knowledgeable and objective person. If you do that, you'll probably be able to offset most of your emotion or flawed thinking.
Right. And just so we're clear, you're not saying don't take the risk, but just understand what the risks are and be proactive about what risks you can actually consume and what you can't, right?
Well, I think that, the key to success in life, as I think about it, is the more I think about it is in fact risk reduction. Because if many people make mistakes when they're young because they have no idea of the risks that they're taking, just like a baby walking around rattlesnakes. When you're 18 years old, you have no clue, but by taking risks and going through those risks, you have built up some understanding of risk. And so it's really about applying that understanding. And, there's nothing more exciting than assessing risk and deciding I'm doing it. And then you do it and you make something great. That's what entrepreneurship is all about.
Right. And having a co-founder helps, right? I mean, because, just having someone by your side who's equally invested, who can challenge all of your thoughts, who you can bounce off of ideas and so on and so forth, that really helps.
Yeah, I think that, the lesson that I've learned, particularly through the pandemic, part of what we've learned is people really value connection, meaningful connection. People crave it. But I can also say that from my experience, whether it's a startup or whether it's just a traditional business, it's lonely at the top. You're facing all kinds of negative things happening in your business. You just can't go out and tell everybody all of those things. So having a trusted, co-founder or an advisor or a friend, but find that person who you can trust and share with them what's going on in your mind, because it could be the difference between life and death, not only for your business, but sometimes emotionally, people will drive themselves into the ground.
Yeah, no, that's an excellent point that you bring up. I think it does get lonely at the top, right? I mean, if you're heading a function, you don't even have to be a founder, but if you're sufficiently senior, then, confiding in someone could be misconstrued as weakness, or that information could be used adversely, and perception matters, right? So really finding that mentor, that sounding board, that advisor, as you said, who you can have this freewheeling conversation with and who can debate your thoughts, push back on things and get you to really stress test your ideas, can be really, really helpful.
Yeah, in fact, at the beginning of this year, I set down a goal, with 350 episodes and all the people that I met in my life, I've got a lot of acquaintances. But my goal at the beginning of this year, when I sat down with one of my friends and he and I do goal setting on a regular basis, I said, I want to go deeper into the most important relationships in business, in life, in personal. And so I actually went on my Facebook out to the people that I know, and I said, I'm starting a mastermind. And sure enough, I've got 5 people in this mastermind now, and we meet every Friday, and we've met consistently every Friday. And, also the idea of an NDA for a mastermind group, or for that person that you're communicating with, to make it so that this really is, I'm going to tell you everything. And I need to be able to trust that you don't share it with others. And that brings us into mistake number 4. And that is misplaced trust. It's shocking how many people go out and just give their money to people that they don't know. If you follow that person down the street and they're going to haggle for a taxi ride or a little bit of food in a roadside stall. Here in Bangkok, we've got fantastic food on the roadside. But you see them haggle for that little dollar, that little cent, that little baht, whatever it is. and then you see them give away. I have a guest of mine, one of my guests, that was basically sent $20,000 to England, to London, to get a chance to be part of a property development that was going on there. And of course, he never saw that money again. So the idea of misplaced trust. So what I say to offset this is get to know the person you're investing with, and remember that trust only develops over time, because it's only through test. There is no hack. There is no shortcut to trust.
Yeah. No, that's a great point. Again, I think relationships compound over time, and it really makes sense to invest in those few relationships, right? I think everything around us sort of favors this networker, right? Quote unquote. So you're always judged by the amount of followers you have on Twitter or elsewhere. And really, we end up with a broad swath of people we somewhat know, right? And who know us somewhat, right? We don't really invest in the 5, 10, or 15 people who could be who could really make all of the difference, right? And really investing in those relationships, whether in life or in business, I think it can be it can be one of those things that makes the difference.
About 10 years ago, I got to know a little bit more closely someone that was kind of an acquaintance. And sure enough, over time, we both put in some effort, and we really started a real friendship. And I look back and I think to myself, and I asked him the same question, and I'm going to ask you, Roshan, as well as your listeners. When was the last time that you made a new good friend?
Yeah.
It's a tough question.
It's a tough question. Yeah.
Because, when we're in school, we're making friends because we're kind of forced to be together, and you do make really great friends. But when was the last time you made a new good friend?
So you know what though? I mean, last year especially, I mean, I've kind of realized the benefit of having old friends. People who have known you for decades, and we somehow lose sight of them, I guess, because life gets in the way, as it does often, right? And you do your own thing and they do their thing. And last year was a lot about reconnection for me, reconnecting with all of those people. And really, I was super surprised to see how easy it was to reconnect back again. And these were people I hadn't spoken to for months and years, right? So yeah, I mean, it is something though.
That's a great point. And one of the things that is great about all relationships is that we can restart them really quickly. So if the listeners out there have walked away from some relationships because they've been so busy or whatever, just pick up the phone. Just pick up the phone.
Yeah.
So let's get to number 5. Number 5 is failed to monitor their investment. It's shocking to see the number of people that give money to other people and then never really hear about it anymore. And this is particularly important in the world of startup, because there's a lot of angel investors and others that are putting money into companies and they're not getting a regular communication. And what I say in this case is that what I try to do is I advise, if you're going to invest in something, that you go to that person. Let's say your friend says they're going to start a restaurant, and you say, okay, I'll invest in that. You just tell them, before you give them the money, say, all I'm asking for is once a week, let's say Monday, that you and I have a half an hour or an hour long conversation. Once a month. You don't need to do it once a week, but let's say once a month that we have that conversation. And I know from my own perspective, when I invest in business, one of the biggest mistakes I've seen that a lot of small businesses do is that they don't get their accounting and finances strong. And therefore they can't really present their performance. It's just, lots of kind of vague charts and graphs and stuff, but it doesn't come into what is the actual profit.
Yeah. Because, and especially, so this is common among engineers, right? I mean, engineering founders tend to focus on the problem and solution, and really sort of miss the fact that a business ultimately has to turn over a profit, right? And not really having that sense to really closely monitor how much am I spending, how much am I earning, and how this thing is going to extrapolate over the next few months. When is my zero cash date, etc., etc. Not having a good handle on all of these things could actually waylay even the best of solutions, best of products, right?
Yep. And I think that many founders they misjudge the importance of accounting, bookkeeping. Let's call it bookkeeping, accounting, and finance. Bookkeeping is kind of keeping the paperwork together. Accounting is bringing that together to get our financial books, and then finance is really to analyze it. Most people don't do these things, and basically there's a cost that must be borne when it comes to bookkeeping, accounting, and finance. That cost is, is related to the people that you pay to do that job. Now, many founders will put off work on those areas because they think it's not generating them income, but that cost will snowball over time if you don't get your accounting systems in place. And what will end up happening is it'll cost you a lot more later to unravel it. But also, when a proper accountant comes in and says, oh, well, you have a tax liability here, both business and personal, that you haven't paid, and now it's grown and there's penalties. And all of a sudden you realize that accounting is super important. And I know this because one part of my business is that basically I cut the Gordian knot of accounting and finance and bookkeeping for companies that can't solve it and don't want to solve it. And basically the end result of all that is really the big lesson here. And that is, you want to make sure that you have monthly financial statements, that you close the books on a monthly basis. And if you can't do that, then it's a bad sign.
Yeah. So no matter what kind of business you're running, it could be like a yogurt shop or like a software services setup, or the next big hot product that's going to capture the world, right? I mean, you really have to know that left hand side and right hand side, that balancing as such, right? I mean, otherwise you're going to be in trouble.
Yeah. And I have a course that I created called Finance Made Ridiculously Simple, where the objective is really to help every non-financial person to really to understand their finances, and then basically start to really want to see their financial numbers. And then I have another program I call how to make your company financially world-class. And that's about how do you benchmark and how do you get the whole management team working together. And this brings us to number 6 out of 6 common mistakes that I've experienced throughout my years of interviewing people. And this one is one that is a catch-all. And this is the one, it's called invested in a startup company. I wasn't sure what to do with it, and I neglected it for years until you asked me to come on this show. Now, up until today, what I said to people about this is I said only really one main thing, and that is start from this reality. You are likely to lose everything.
Yeah.
And the point is that startup is a binary thing. But since this show, I've been working, since you and I talked a couple of weeks ago, I've been working to try to pull something together, and I've come up with 6 common mistakes that startups do. So I think we should go through them. Ready?
Yeah, sure.
First mistake, most common, bad hiring decisions.
Familiar with them?
Yeah. Second, most common mistake for startups is poor management of time and people. Number 3, and this one I'm going to talk about for a moment, ineffective teamwork and collaboration. The reason why I want to stop and talk about this is because as a PhD in finance, a CFA, as well as a person who's taught finance and worked in finance all of my career, one of the things that I've seen is I had 2 clients I want to tell you about. I was advising the management team of 2 clients, and I was training them in the world of finance to help them get great financial performance. These 2 management teams, if you interviewed any of them individually, they were all great, smart people, highly qualified, highly educated. And the CEOs were pretty good. But what I found was one was doing much better than the other. And I came to a conclusion after looking at them and looking at many businesses as I've analyzed for the years, and that is, there's really 2 things that make the difference in business. I mean, anybody can hire developers, anybody can buy equipment. The 2 things are good leadership from the CEO, and number 2 is collaboration amongst the management team. If you don't have good leadership, you're dead. And if you have good leadership, but there's not good collaboration and teamwork in the leadership team, which happens all the time, right, that it falls apart, you will not be successful. And finance, I always say that finance is a mirror, and finance adds no value. It is a measure of how effective your CEO is and your collaboration within your team is.
Yeah.
So
go
ahead.
That part about leadership is absolutely true, because I think the number one defining factor in scaling a startup is the second rung leadership that the founders build, right? I mean, this could be your VPs of product or technology or, whatever else. It really, really is a huge differentiator. And, quite often you see even slightly mature startups where the founder is directly involved in, let's say, sales or product decisions. And founders tend to be hands-on, of course, right? But really at a certain level, let's say the 5 million or 10 million mark, you really have to have these leaders. I would say even earlier, right? You need to have these leaders who can run their functions, right? Because obviously, as much as the founder knows about the vision and all of those things, you really need some functional depth. You need those guys to really run. And also the point about collaboration, right? Very, very important again, because considering that functions tend to overlap with each other, right? A little bit of competition is fine. I mean, and sales and marketing often is the classic trope of hey, where are my leads, and hey, what happened to the leads I gave you, right? So it really, really helps to get on the same page, like all of your VPs and all of your functional leadership getting on the same page. I mean, it's a sight to watch, actually. If you have them running like a well-oiled machine, it almost seems like no work at all.
Well, when I was about 23 years old, I ended up in a course taught by a man named Dr. W. Edwards Deming, the father of the quality movement. He was 89 at the time, and I went back to study with him again when he was 92. And what I learned from him is, like you said, a little bit of competition. He would say, your job is to remove competition in your company. Your job is to build collaboration and teamwork. And that goes against the traditional, let's say, US method of KPIs and everybody's working on their own little area. And he found those things very offensive and felt like you're just setting up problems. And that's the reason why it's so hard for many teams to collaborate, because in fact, we design things that force competition between different people and teams. So let's get on to the next one. So number 4, most common mistake made by startup is they waited too long to start selling.
Yeah, this is a good one. I guess you start selling before you build, right? I mean, that's really how you have to do, because I mean, if you look at something like the enterprise, for example, or actually, I mean, any startup, right? You always have to be selling. I mean, you have to put the customer at the middle of all of your product building and everything, and go to market before you actually go to market, right? And there's that whole fail fast, ship fast, and all of those 20 other variations of all of that, right? So which is to say that you can't really build in a black box. You can't be siloed. You have to involve the customer. You have to involve the customer, put him or her at the center of the experience, and build around their needs, right?
Yep. And until you sell, you really created nothing. And think about the apps on your phone as an example when you're using them for free. And if they ask you to pay $20 a month, you probably say no to many of them. And that's why selling is so important, not just testing with the market. And I want to tell 2 quick stories about this. One was from one of my guests, and he had an idea of selling wine in Cambodia. And he went through a process of getting the licenses, and it turned out it was a huge amount of work to do this, to get the import licenses and then set everything up. And then he started selling, and he just couldn't make it work. And in the end, he folded that business and he lost money on it. He was able to sell some of what he had. And I asked him, what lesson did you learn? And he said, start selling. And I said to him, well, how can you sell when you don't have the license and you don't have the product? You've got to import it. He said, I should have just gone to a wine company and said, hey, give me a pallet and I'm going to go sell it. And they would have sold it to him for sure.
Yeah.
Just start selling. Boom. All right. Number 5, weak accounting and finance. And again, many companies and many founders just ignore this. And what I've learned now is the best measure is, can you show me monthly closed books That means a P&L, a balance sheet, a cash flow statement every month, consistently, correctly done, and on time. If you can do that, then this problem won't be a problem for you.
Right. Yeah, I guess this is the number one thing that founders have to learn, right? Because they're makers, they're product people, and really they have to learn some basic finance in order to be able to run their business. So, Andrew, what are those 2 or 3 elements that somebody should know?
Well, I think that, there's 2 ways to approach this. First way to approach this is to learn about accounting and finance. People like myself and other people teach it. There's all kinds of stuff out there. And I'll even include some stuff that in maybe in your show notes that they can look at and see if it helps. There's a second way of doing it, and that is don't learn it, but just do it. And have an accountant in your company. Just now, from this conversation, I want monthly financial statements. And if you start to get those on a monthly basis, you'll start to become very familiar with those. And you will actually start to become a financial manager. And what does that mean? It means your business decisions are made in a financial framework. And if you are not doing that, it's going to be, unless you're just the luckiest guy out there with the most amazing product, you are going to struggle and probably fail. And that brings us to our last one. But yes, you had something?
No, I just thought it was interesting to be able to look at a business as an investment, right?
Totally. And you're investing so much. An outside investor is just investing their money. You're investing your money, your time, your life, your energy. And I told you I had 2 stories to tell you about waiting too long to start selling. And I forgot to tell you the other one. So let me tell you it right now. When we started our coffee business, Coffee Works in Bangkok, we roasted, my business partner roasted all of our coffee and sold all of the coffee. And on the first sale, we were supposed to have a really nice tin, foil bag with our branding on it and all that. But the bags came late. The customer had ordered and we were screwed. And so Dale hurried up and got the production people together and they packaged it up, and he arrived with the product, and the product was in Ziploc bags. Here was these Ziploc bags filled with coffee with a little sticker. You can imagine like a Post-it note on a Ziploc bag. And that was his minimum viable product.
Awesome.
And they bought it. So the last one is low product quality. If your product doesn't work, if you can't do and deliver consistently great quality, then you're never going to get anywhere. And so low product quality is the final one. And I just want to say that I have a saying, and half of it I've heard before and the other half I made up. And that is, the first half is revenue is proof of concept. And what I say is profit is proof of competence.
Yeah, that's a fantastic quote. I remember that from our podcast. I made a note of it. Yeah. So I have a few different questions to ask you, Andrew. I mean, if we're through the list.
Yep.
All right. So failing to do research. Now, oftentimes you find entrepreneurs building in domains that they're not entirely familiar with, right? I mean, you can think of classic disruption in finance, for example, right? I mean, these were a bunch of tech guys who went about building the entire fintech, and now what you're going to see with cryptocurrency, blockchain, all of those other financial disruption, right? What would be the best way and the quickest way to build that domain expertise for a founder?
I oftentimes say, if you don't have that expertise, get an advisor. And if you can't get an advisor, then hire another person with that expertise. But like there's just no other. Yeah, like a co-founder, or just the head of that particular, maybe it's the head of your development department or whatever. But hire the people. In fact, that's the best lesson I've learned over the years is do not hire people like you. Hire people who have skills in other areas.
Yeah. And that way you can actually complement things, right? Because experts won't give you new ideas, but then experts will know what currently works, right? So you have a fair mix of, domain expertise and innovation in some sense.
Yeah, I mean, that's the thing about having an expert advisor, let's say in the area of finance. They're not a full-time person looking over your shoulder everything you do, but they're giving you bigger picture perspective. And that allows you to do your innovation and test your ideas, but also have a check, that helps you stay, within a reasonable area.
Right. Okay. We also spoke about the importance of risk, understanding risk, right? How do you assess risk? Because if you look at startups, 99% of startups fail, right? And some subset of that really become successful and get all the glory, right? But we're all in this whole startup game and everyone wants to start up. Uh, how do founders and operators assess risk?
It's very hard. I think the first thing you have to say is that it's just full of risk in the world of startup. It's like, in a swimming pool, you have the shallow end, and that may be, investing in ETFs or investing in funds. And then you've got the deep end, which is investing in stocks and things like that. And then you've got this deep sea that goes down, 1,000 meters. And that's the startup world. And and it's filled with sharks. The sharks aren't in the shallow area. And so right from the beginning, you have to be aware that you're going to be wiped out. You're going to be running out of money. You're going to be running out of confidence, yourself, other people. So first thing is to recognize that you're going into an extremely risky area. The second thing is to think about these mistakes that we've talked about and how do you mitigate them? Let's look at some of them. First one you do is you do your own research. Right now I'm working as an advisor to a company that's an agricultural company in Thailand. And I'm preparing their information memorandum for capital raising. And, it's interesting that, they have great ideas and they're just putting it into action, but they haven't stopped and researched it and really made sure that it's very clear. So first thing I think is by researching it. The second thing I would say, you've got to, there's certain mistakes that you cannot afford to make. And, when I worked at Citibank many years ago, if I had a bad day and didn't work that much, Citibank's going to do just fine. And if I had a bad week and I didn't work that much, Citibank's going to do just fine. And if I had a bad month and maybe someone died in my family and I was sad and depressed and I just didn't have a good month, Citibank's going to do just fine. But you won't as a startup. So you have to have a heightened awareness to say, I cannot afford to make these mistakes. I cannot afford to hire people. And, as I always say to people when they're not that productive, I say, good news. There's big companies out there you can go work for that you can not produce that much. But in the startup world, you just don't have the runway.
Yeah. I think a lot of it is driven by idealism. Founders think that they're out to change the world, which is right. I think you should have that optimism about your vision, right? You don't want to be mediocre about that, but also you have to root it in some amount of pragmatism and really assess things for what they are. Yeah.
And that's the beauty of financial statements on a monthly basis.
Yeah.
You
Absolutely.
can't, they just are staring you in the face. And you may say, well, Andrew, come on, I'm going to take over the world and I don't need to make profit right now. Then measure your loss.
No, it's a great point. Yeah.
It doesn't matter whether you're saying we're going to just spend and lose a lot of money for the next 3 years. And our founders and our capital providers are okay with that. That's fine. Still measure your loss.
Yeah. No, that's, yeah. So fundamentally, I look at it as two types of businesses, right? You have the profit loss business, which is like, let's say running a yogurt shop, right? The cost of goods and then, what you sell and, the difference is what you earn, right? So, and then you have the profit loss or the balance sheet sort of a business, right? Where you build assets that can be monetized over a period of time. And then, you run all those fancy valuations and then, perhaps somebody or the market pays you an X amount of dollars for that, right? And these require different mindsets, but then being aware of, your burn, for example, or how much you're paying to acquire a customer and so on. I think these are common irrespective of what kind of business you run.
Yeah, in the world of the stock market, where I've operated all my life, we have two types of gains. We have dividends and capital gains. Dividends also can be paid out as share buybacks, but let's just call them dividends and capital gains. The point is that some companies, their objective, if it's that yoga studio as an example, you better get to dividends pretty fast, meaning cash flow. But You may decide that your business is all about the capital gains and you're building up the assets, but ultimately the build out in assets has got to lead to a huge payout.
Yeah.
And that's so you can forego the cash flow.
Mm.
By the way, someone asked me a question. What's your number one advice? Because I run the valuation masterclass and I have thousands of students, and I've been teaching valuation and doing valuation for years. And that's just an expertise. Somebody asked me, how do you increase the value of a startup? I said, the first thing you should do to increase the value of your startup, listen carefully, startup operators, is double your salary.
Okay, you'll have to explain that one.
So my point is that most startups are struggling to survive. The founders and the management team are saying, we're taking low pay and we're going to get paid in the end through equity. Now, of course, that's okay in the beginning. But eventually, over time, when you're talking about being bought, the problem that we often face is that a company may be making a small amount of profit and you may think that this is a great business. You may think your business is great. But if you ask me to come in and buy that business, the first thing I'm going to say is, imagine that my whole management team ran away and I've got to go out in the market and hire the management team to run this business. And they got to be qualified in order to really take this business to the next level. And therefore, I'm going to have to pay market price. And the result of that is that all of a sudden, what looked like a very profitable business is actually a loss-making business. So my challenge to the listener is that as soon as possible, you should not be paying yourself a very low salary. You should be increasing it to market rate. And you should be trying to generate a profit at market rate. And if you can do that, that means that you really can have a real business that a company can buy and not be hit with a lot of additional costs.
Right. Yeah, we see a lot of the fancy accounting, right? I mean, especially with startups and so on. But, what do you make of these build to sell sort of businesses, right? I mean, uh, that are very clearly being run with this whole valuation in mind, and then, a payout at the end of the journey, right? What is your experience of these sort of businesses? Any advice on that?
Well, I think that from an investor perspective, I want to invest in a company where a founder and his team or her team is really out to change the world. They're out to bring their product and service to as many people as possible, and they just see it as a great mission. That's the group that I want to invest in, first of all. Now, we do have some people that are just focused on spinning that asset out and selling it or something, but let's focus on this team for a moment. Sometimes when I talk to groups and teams like this, they talk about exit. They say, well, we want to present an exit plan, particularly as we're raising money and all that. And they say, in 5 years, we want to have a trade sale, blah, 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 blah. We want to list it in the stock market. And I always tell them, wait a minute, the exit's not for you. The exit's for the investors. Most people think, and so what I always tell, now that's fine. You may be able to exit with the investors. But the whole point about talking about an exit when you're pitching your deal is to show the investors that they can get in and they can get out. But if you're just telling, we're going to run this business until we all exit in 5 years, that may actually cause the investor to lose confidence in you rather than if you just say, I'm running this for the next 20 years. And if the exit opportunity happens and you decide to take it, great. But I would never go out and say that. Now, there are a small number of people who are really good at starting and spinning off assets. If somebody's got good experience in doing that, nothing wrong with that. That's just a different way of doing it. But for majority of people, I would say, you're in it for the long haul. And that is what the investors ultimately want to hear.
Right. Yeah. And, one of my final questions, since we spoke about being driven by emotion and and how that affects the way you run the business itself, what is your advice in terms of going and getting a co-founder?
Well, I think that the fact is that, I can just give you the example in my own life. Dale, my business partner, runs the business as the co-founder and the managing director. And I'm a director, but I do not work in the business. So what I do is I run my own business, which he has a share in that business also. But the point is we talk every day. and we go through what's going on, and I know exactly what's going on in the company. And many times Dale has turned to me and said, I couldn't have done this alone. And I know that there's listeners out there that have that feeling today, that I'm just alone doing this and it's wearing me down. And so I think it's an important thing, is that you've got to find either a co-founder or high quality people to work with. That's the key. And I have two different businesses, and both of them, my business partners, Dale and I, have known each other for almost 40 years. And my other business partner is a Thai man, and he and I have worked together side by side for 20 years. And it's with those relationships make all the difference. It means that you can make it through. So I can't give specific advice of how to find that person. And I don't know whether that person should be a co-founder, or whether they should be an outside advisor, or whether they should just be a couple of good people on your team. But all I can tell you is, for the listeners out there, if you feel alone, if you feel like it's really wearing you down, you've got to ask for help and try to figure out how to find some other quality inputs into your life.
Yeah, I couldn't agree more with that. I couldn't agree more. So, all right, that's a great note to end the podcast on, Andrew. Any closing thoughts?
No, I just say thanks for having me on, and it's fun to share these things. And I think the point is that we've went over a lot of mistakes and negatives, but the fact is, I just want to take my hat off to all the listeners out there, and to yourself, Roshan, for trying to change the world. It is ultimately the entrepreneur, the founder, the startup operator who is truly trying to make this world a better place. So hats off to you.
Fantastic. Thank you so much, Andrew. A lot of insights in this podcast, and I'm sure all of the startup operators listening to this will really, really appreciate it. Thank you again for being on the podcast.
My pleasure.
Thank you so much for listening. If you liked this episode, then don't forget to subscribe to us on your favorite platform and share this episode with all of your fellow startup operators. Also, follow the Startup Operator on LinkedIn and Twitter for more updates. Stay safe, take care, and see you soon on a brand new episode of the Startup Operator.